Hi, this is Dustin with Dustin's Dollars. Today I'm be talking more about Knightscope, about their 10K, their annual report that they filed last week. A couple more of my thoughts and takeaways from the 10K. Um, Before I get into it, let me remind you that I am not a financial advisor or a financial professional of any sort. All opinions that I express in this video are mine and do not represent those of any company or any other individual. I do have a long position in Knightscope. So basically this video should be for your entertainment purposes only because I could be wrong about everything that I say in this video. You need to do your own research before making any investment decisions. So that being said, I did talk about this a little bit yesterday. I touched on some of the revenue, the machines in progress and that they've built and that are ready to be on lease or are on lease. If you didn't see that yesterday, go ahead and check it out. Today I'm giving couple more of my thoughts on the 10K and talking about just a couple things that I picked out of there that I thought were interesting. First note, I would be remiss if I didn't start off with this, given the news today. There is a note in here that they've included something similar, I think, in the prior release, but they're very clear here, and they have this note that says they're talking about the liquidity, and they say, however, as the company did not raise the full offering amount, and just to recap that, right, they were looking to raise $40 million in the offering at the end of 2021, beginning of 2022, and they did not raise the full 40 million. They raised about 22 million, 22.3, I think, offhand. That's actually what they sold, and then there's a discount on what gets back to the company. So I think they got right around 20 or 21 million dollars in cash issued to them, issued to the actual company. Oh, there you go, right there. They generated net proceeds of approximately $20.2 million. That's right there in the filing. So anyways, the company did not raise the full offering amount. Management's plans include seeking additional financing activities such as issuances of equity, issuances of debt, and convertible debt instruments, right? And so they very clearly called this out in the 10K. I think similar language was in the 2021 Q3 10Q report. I'm not 100% sure on that. It doesn't really matter. But we got a little bit of that today. This was the news. Knightscope announces $100 million in a committed equity facility with B. Riley, and there were not a lot of details here, so I'm not going to spend a lot of time on it today. They did say that they're going to, but basically they have some agreement such that Knightscope can, it reads to me like Knightscope can tell B. Riley when that they want B. Riley to purchase stock, and that they have this agreement to sell up to $100 million of its stock to B. Riley over over a period of 24 months. So it does say it's at Knightscope's discretion, but it's subject to certain limitations and conditions. We'll see. Again, like I said, I'm not going to spend a lot of time on it today because there's more details that they are going to file hopefully soon on an 8K that we'll see in the near term. And I mean, I'm going to reserve really any material commenting on this until they file that in terms of whether I think it's actually good or bad for shareholders. I mean, I think net it's going to be at least positive in that I talked about this yesterday, that they have like 14 or so months, 14 maybe 15 months of cash runway at their current rate. It seems like they're actually increasing their burn rate, right? They're hiring. They're talking about even opening another office in Washington D.C. All that costs money, and it wasn't really clear exactly what they were going to do at the end of that time, because there's no way they were going to be profitable by that point and be able to fund the company just from cash flows. So this at least gives some clarity that the company does have a plan to continue funding operations for multiple years, even past that point, to hopefully grow the company to the place where they are much closer to funding from cash flows. So that's all I'm going to say about that today. And apparently the market liked it. It's up 8% after hours, after even a plus 10% day today before the news came out. So that's all I'm going to say about that. Now, getting into the 10K, I did touch on the revenue yesterday, but what I did not really get to touch on was their cost of revenue, right? And that's what this is. I've talked about this before. Knightscope has a negative gross margins. It's a complex topic. I have a whole video on how they could potentially improve those. I'm going to talk a little bit today about what insights we do get into what are the components of that. spoiler alert, we don't actually have that much visibility, and I'm going to send an email to Knightscope Investor Relations to see if I can get more information on that. I'm not expecting much, but we'll see. I'll make a video about it if I do. But I'm going to go over the information we do have today. But if we just look at it at the sort of the top line of the high level components, the blue bars here are in this chart are the revenue for each quarter, and I pulled this from their filings, from their 10K, their 10Q, and then their 1SAs and their 1Ks that they've filed in the past. And for the periods like the beginning of 2020 and the beginning of 2021, where I didn't have quarterly information, I just took the 6-month information and averaged it out. And that's going to be true for pretty much all of these charts that I show you today, just as a sort of a note on the methodology for what I did here. But if you look at this, you can see over the past 2 years, quarter by quarter numbers. The blue bars are the revenue. You can see the revenue has bounced around a little bit, but sort of as I covered yesterday, is still in roughly the same range. Hasn't really grown. You can see the red bars here, their cost of revenue has actually gone up and down and then up, and this last quarter ticked upwards quite a lot. And then this yellow bar is just the difference between them, right? The yellow bar here is their gross loss, and you can see it's very, very plain to see here when you look at those yellow bars that their gross loss has actually been growing over time. So it's growing over time, and revenue has not. So you can't even say that it's like a percent of revenue that you can't make the argument. I don't think this doesn't support the argument to say that yes, they actually have negative margins. Even as they scale up, they're just going to lose even more money, right? Because you see a larger gross loss, but you haven't seen revenue go up. And which means they haven't actually deployed a lot more robots. So it's not that we're seeing a bunch more costs because they deployed a lot more robots. There are other factors involved. And again, I actually don't have full visibility on that. I wish I did. It's something that it is a concern for me, but I think, again, said it yesterday. I think that we will see more inklings when they do actually grow revenue of what those margins start to look like as they scale. So that'll be interesting when they start reporting, for Q1 in mid-May, I think. And this is what the graph of the gross margins as a percentage looks like as a percent of revenue. And like I said, this past quarter was, by far their worst, at least in the past 2 years, as I compute it here. So, they had almost, I think it was like a negative 93% gross margin, which is so, on the surface, it's so bad. Obviously, the reality is more complex than that. So getting into the information that we are able to glean that I was able to glean from their 10K in terms of what do they actually build in that revenue, right? And the interesting thing, just one thing to keep in mind, is that not all components of that revenue are even cash components. And you can see here, we have, these are the known revenue components with the cost of revenue components. This doesn't include, my graph got messed up. I'm sorry. Well, so these are the components that we do know about. And we can see here of the things that are reported, right? They report stock-based compensation. They report shipping and handling costs. And for that, we don't have the direct numbers. We just have the annual number, and I just divided that evenly. I divided that across each quarter as a percent of revenue, I think. Either percent of revenue or as a percent of cost of services. I think it was a percent of revenue. They distributed just a little bit, not evenly across all the quarters, but that's not a big deal, I think. We also know what their service fees were to Konica Minolta, right? And I've covered this before. Konica Minolta is a partner of theirs that will go out and do service calls on their robots, right? Because they deploy all across the nation. Knightscope has 55 employees. They do not have staff all across the nation to service the robots. And so they have this contract with Konica Minolta. And so we get a little bit of visibility into how much they're actually paying for those service calls. We see the depreciation of the cost of revenue, right? That is very clearly called out in the filings. And so we know how much of that cost of revenue is actually taken up by depreciation. And then I estimated, right, their rent expense, that is a portion for their assembly. I don't know if you call it manufacturing, but the assembly of the robots. And I estimated this is totally a number that I made up. So feel free to criticize at 40% of their total rent expense. Figured that was about, that's just my number. That's my guess. It could actually be 60, it could be 80, it could be 20. I don't know. But you know, they have this facility. I think they say it's a 15,000 square foot facility that they rent. 15,000, yeah, 15,000 square foot facility. It's its headquarters. This is where it designs, engineers, tests, manufactures, and supports all of its technologies. I would imagine that the manufacturing and the support is the component that actually is sort of attributed to cost of revenue, as opposed to those other portions that get included in R&D or SG&A. So that is what I did. I just did a flat 40% of their rent expense to include there. So one other thing, actually, if I scroll back to my real numbers and not the graph, is I did actually have, and I should put it on here. See if I can make this larger just momentarily so that you can maybe read the numbers. What portion of the revenue is actually unattributed, right? That those things that I just called out, those add up to a certain number. That number is not their entire reported cost of revenue. And I could actually add this column or this row in real quick. Unattributed cost of revenue as percent of cost of revenue. And I'm calling this unattributed because I can't really figure it out from the things that they've reported as far as what the rest of that number, where the rest of that number comes from. So if I would do B13 divided by B4, you can see that that's 58%, 58, 56. So we're seeing roughly mid 50s to 60% of that cost of revenue is not obvious where it comes from because it's not called out anywhere else. And again, maybe I'm wrong on my allocation of the rent. That's really the only thing that had my judgment in it. The rest of this, I just don't know where it comes from. So like I say, I'm going to email investor relations to see if I can get a little bit of insight into that. We know that some of this are their fixed costs, right? They've talked about what are their, what comprises their cost of revenue. Let me make this back, reset my Zoom real quick so I can read my notes. They do call out the increase in cost of revenue. It was primarily related to increased depreciation, which we saw that, service costs, which we saw that, consumable supplies and hardware costs related to deploying the ASRs, as well as increased personnel costs, partially due to increased headcount, right? That is actually a quote somewhere in here. I could actually probably pull it up. Increase, yeah. So the increased cost of revenue, that this is where it's at in the 10K. And we don't have insight into a lot of these, but then, as I said, it's actually not even just the increase in the cost of revenue. We're just talking about what comprises the cost of revenue overall. And I think they have a note about this in here somewhere, right? That we also don't know, right? This includes obviously depreciation, which we do have, but labor and associated benefits, we don't really have that. We don't have data communication fees. Routine maintenance costs, I don't know if that's all covered in the service cost of Konica Minolta or not. It's also not obvious that the parts that they would use in those service calls are actually included in the cost for the services or not. Again, we did call out shipping costs. We did have that. And then other direct costs incurred during assembly and deployment. We don't have any of those. So, yeah, it would be interesting to know what is the majority of the rest of these. I don't know if it's somehow, parts in there or what, I don't know. Anyways, going back to the more interesting materials and the graphs. So I have that. And then we can look at their operating expenses, right, per quarter. And these are each broken up with their own line here. These don't stack at all on this particular chart. And you can see that, sales and marketing was way above the other two for almost every quarter in recent history in the past 2 years. You can see if you just look at the red line, the G&A, you can say that's been going up. It did actually go down for a bit, but then it has been going back up. And they call this out, that I think that's they say, oh, I lost it. I had it in here, but they say, I'm pretty sure they say that the G&A is going up because they need an accounting team. They hired a CFO. Right, so that's my recollection on their explanation for why those costs are rising, and I think it makes sense, right? They're becoming a public company. There's a little bit more they need to do for accounting there. That makes sense to me that's rising. I don't expect that to continue rising, year over year over year. Not at the same rate that the company could grow, right? I think R&D also, you see this rising. I'm actually a little surprised that it hasn't risen more. I think we are going to see more in the next year or so. the R&D expenses are going to go up, right? I've gone over those job listings. They have listings for engineers, some sort of specialized engineers, even ML engineers and such. And so I think we are going to see those R&D expenses tick up a bit. But obviously won't call it the elephant in the room because it's pretty obvious. It is the sales and marketing expenses way above the others. And the most interesting data point to me is actually the Q3 2021 reported numbers, where you see this major tick downwards, down where it's actually, I don't know, one fourth of what it was the quarters before. Right? If I look at this is an average over 6 months, these two data points here. So this was $3.3 million in sales and marketing, on average. This is actually average over the 2 quarters. So over the 6 months, it was, $6.6 million. In Q3, the reported numbers, it was 697. So $700,000. So I guess what's that, a decrease of 80% or so? That's humongous. And then you see that it ticked way upwards, 4.7 million in the final quarter of 2021, if I did my math correctly and pulled this number. So they do explain this. They do have a note here talking about, it's probably right down here. I'll do the search. Increase in sales. Yeah, so the increase in sales and marketing expense was primarily due to an increase in the company's advertising expense during the 2020 and 2021 Regulation A offerings. They say as well as increased investment in professional services to support sales during 2021. So this is actually what we've seen, right? In the past, we have seen that, they've called this out, that their advertising expenses were massive. And I don't think that they split out advertising costs. Oh, they did split it out. How did I miss that? Sorry, I didn't have that. So advertising costs as recorded in sales and marketing, this is for the whole year, was $9.7 million. So almost $10 million of their entire year's sales and marketing was just from advertising. So we go back up and we look at their sales and marketing costs for the whole year. It was $12 million roughly, right? And so we can see that the vast majority of this is advertising. And that actually tells me that number might come down drastically, because as I've covered in the past, I think a lot of those advertising costs were really intended to advertise to investors, people who are investing in the company. And I think now that especially today, as they announced that they have that agreement with B. Riley, they've got their source of funding, for new cash coming in through investing activities, I guess you would call it. Investing or financing? I guess it's financing. Sorry, I'm saying the wrong thing. Not a finance professional, right? Not an accountant here. But I think we're going to see those advertising expenses come down drastically. We might see sales and marketing expenses a couple quarters that come back down to these sorts of levels, right down to $700,000, not $4 million per quarter. And so that would actually be very, very welcome for the company, and that saves a lot of cash burn, obviously. And that actually even might explain some of what I talked about yesterday, where they, looking backwards over last year, I think we saw that their actual cash burn rate on average over the year was I think $1.8 or $1.9 million per month, even though in their filing they projected 1.5. They said we expect to spend $1.5 million per month. We expect negative cash flows of approximately $1.5 million per month on average for the next several months. And I think part of that discrepancy there might just be from lower advertising costs, because they're not trying to make a big push to get lots of eyes on the stock and on the company in order to invest in the stock. So that is my thesis. And then if we stack these up just to see how overall, how have operating expenses grown over time, you can see, sort of that the yellow, again, these are stacks. So you see the very top line there, the yellow line is your overall OPEX. And you can see that has been ticking upwards. But again, if that sales and marketing expense comes down due to, much lower advertising, you're going to see this actually maybe be lower than it has been, or maybe match what it was near the beginning of 2020, even including the increased R&D and the increased G&A. So a couple other things from the 10K, and before I wrap up and call it done for today, they did reiterate FedRAMP in target for approximately the end of 2022 That was good to see. I want to keep seeing that. I want to see that in the next filing, and the next filing, and sooner or later, I want to see that, press release that they've achieved FedRAMP compliance. I've talked about that many times before, so that is what it is. But that was good to see. Customer concentration, right? This is actually down a little bit from the numbers they are reporting. Unfortunately, they stopped reporting how many clients they have, right? In prior filings, they've said we had this amount of clients and this amount of machines and network. So you could do some math and sort of see roughly, on average, how many robots they had per customer. And I think they even might have listed out their largest, at times at least in comments and public press releases, they've said how many machines they have at certain client sites, not necessarily naming the clients, but hey, we sold 5 machines to this client here, et cetera, et cetera. But they've stopped reporting some of those numbers. But what they do say is that for the year of 2021, the company had 2 clients who individually accounted for 10% or more of the company's total client revenue, right? 15% and 10%, whereas the year before, they had 3 clients that accounted for at least 10%, and they were 21%, 15%, 10%. So they have lower client concentration risk, although that's still really high for a company, right? And this is what you expect. They're still very early on, but I'm looking forward to the day when they say, we have no clients who account for 10% of our total revenue. So hopefully they're not too far from that. All right, so that is roughly what I wanted to cover today. Let's see, nothing in the live chat. Let me give just a shout out. Yesterday was great. We had some folks join in and ask some questions, and I'm always happy to have anybody join in. I do most of the videos I do live. So if you see me live, feel free to hop on there. I would love to have some back and forth and some chat. Anyways, that is all I wanted to cover today. So thank you very much for watching, and I will see you later.